Welcome, everybody. Welcome, everybody. I'm glad you're joining us today. We've got a lot to talk about. There's been a lot of stuff going on in Congress and Washington this year with different tax laws. And you'll have to bear with me because I was having trouble with being able to share my screen properly. So Dan said he would graciously move the slides here. So if you want to just flip forward to the agenda, Dan, I'll show you what we're going to talk about. It is, again, we're happy everybody's joining us here, and it's a beautiful December morning in Wisconsin. It's 7 degrees outside on December 7th, so that was pretty interesting this morning. And it's also Pearl Harbor Day. December 7th is Pearl Harbor Day. That was 80 years ago today, actually, for any history buffs like myself. So we do have a lot we're going to try to cover today and get through. These are the three basic things: the general federal tax update, because everybody's probably been hearing in the news a lot, all summer, all spring, summer, fall, about, all this back and forth in Washington about these potential tax law changes. So I'm sure you're all very interested to hear what's going on with that. We do have some general tax updates, some limitations on things like the standard mileage rate and just some of the general updates. And then Dan is going to talk about the employee retention credit a little bit later, which has been very, very beneficial to a lot of our clients. So before we get started, I know sometimes we have people trickling in a few minutes late. I thought we'd start off with a little bit of fun stuff here. I've got some income tax quotes here, which I like to share once in a while. The first one is from Albert Einstein. He said, "The hardest thing to understand in the world is the income tax." And, that's one of my favorite ones just because it makes me feel smart, since he thought that. So the next one, "The income tax has made liars out of more Americans than golf." Will Rogers. The third one I like a lot: "We'll try to cooperate fully with the IRS because as citizens, we feel a strong patriotic duty not to go to jail." That's Dave Barry, if anybody's familiar with Dave Barry. He was a humor columnist. I don't know if he still writes stuff. That was back probably in the 80s or 90s or early 2000s. He wrote a lot of kind of funny comments. And then I got to give kudos to one of my clients. A few weeks ago, I was talking to a client on the phone about all the different stuff going back and forth and the provisions that have been introduced and then dropped and moved. And he said, "John, it's like the Wild West out there." So I give kudos to my client for making the list of some of my favorite income tax quotes this year. And I like to just have a little bit of fun too. And again, being a history buff myself, I think it's interesting for some people to know where this all started and where it came about. So I think sometimes people think it's interesting to hear about the very first Form 1040. It was in 1913 with the passage of the 16th Amendment to the Constitution. And the first Form 1040 was 4 pages long, and it had 1% to 6% rates. So if you were super, super wealthy, you might pay 6%. Compared to now, the rates are 10% to 37% rates. And in 1913, there was the Personal Income Tax Division of the IRS was established with 30 employees. And, it's hard to do this on a webinar. I prefer to have a room full of people, but if anybody wants to try to guess how many employees does the IRS have now, the answer is approximately 75,000 employees with the IRS right now. And of course, 2 years later, people started complaining that it was already too complicated. So I think that's a little bit interesting. And so back in 1913, this Revenue Act of 1913 and the 16th Amendment combined were approximately 27 pages in length. And the current Internal Revenue Code right now is a little over 4,000 pages. So it's you can tell things have really just exploded and went crazy. This act that we're talking about today, this Build Back Better Act, is about 2,100 pages. And that's not saying it's going to add 2,000 pages to the 4,000, but 2,100 pages of one bill in Congress is a very hefty bill, and there's a lot in it. So we're going to be talking a little bit about that. And then lastly, just for the fun of it, in 1913, the total entire federal government revenue for the year was about $28 million is what they took in. And now in 2021, the federal government is actually spending that same $28 million every 2 to 3 minutes, which I think I did the math right, I hope. I think that the federal government will spend about $700 million during the course of this 1 hour webinar. And so it really, it boggles the mind if you really try to think about it. So if we were to do this as an 1.5 hour webinar, we'd probably be over $1 billion of federal spending. And again, like I said, it's almost to the point of being ludicrous how much money the federal government is spending. So So to get into the meat and potatoes of today, we're going to talk about primarily these two bills here. Dan, you can flip to the next slide here. Let me start by saying earlier in the year, there was some COVID relief bills, and that was, I forget how many, a few $1 trillion worth of bills. But really what we're going to focus on right now are the two things that have happened recently. The first one is referred to as the infrastructure bill. That was about $1.2 trillion. That actually was signed into law. It was passed by the House and the Senate and signed into law by the President on November 15th. That is primarily a spending bill, like it says here, roads, bridges, broadband, electric. There really wasn't any tax provisions in there that would affect, I would say, any of our clients. The only one thing that was in there, which Dan will talk about later, is it did end the employee retention credit as of September 30th. But other than that, there's really not much in that infrastructure bill that I think we need to know about from a tax standpoint. So really what I'm going to focus on for the rest of this presentation is the next item here, this number 2, is called the Build Back Better Act. And you've probably been hearing about that in the news for a long time. Right now, that's about $2.2 trillion. That was passed in the House of Representatives in Washington. However, it has not passed or even been voted on in the Senate. So that has not been enacted into law yet. The Build Back Better Act is really all about, they call it kind of the social bill, the social and climate spending. There's family leave aid in there. And this is the bill where there's all of the tax changes that I think we're going to want to make you aware of as part of this bill. And then the little asterisk here, this Build Back Better Act is also known as the reconciliation bill. And I'll explain that in a little bit why it's called that. And so if you hear me refer to the reconciliation bill in this webinar, what I'm referring to is the Build Back Better Act. Saying Build Back Better, that is, if I say that 100 times, it's going to get monotonous. So I may just refer to it as a reconciliation bill here, but pretty much everything else we're going to talk about now is this Build Back Better Act. And, so we've got $1 trillion in the infrastructure bill and $2 trillion in there. I think it's interesting to try to conceptualize, what is $1 trillion? I mean, it's hard to even, at some point they just keep talking about spending trillions of dollars and everybody's eyes just gloss over. So I thought it's interesting. Everybody's familiar with what $1 million is. They can kind of conceptualize what $1 million is. So $1 billion with a B, that's 1,000 million. And $1 trillion would be 1,000 billion. Or another way of putting it would be 1 million million. So if you have $1 million and then you have 1 million of those, that's $1 trillion. Or to put it in the concept of time, 1 million seconds is about 11.5 days. 1 billion seconds would take 32 years, but 1 trillion seconds would be 32,000 years. So the difference between 1 billion and 1 trillion is really just a huge amount. Sometimes you think, oh, 1 billion or 1 trillion, but 1 trillion is a lot of anything. So I thought that maybe be a little interesting for you as well. You can go to the next slide, Dan. Oh, and this is just a caveat here. Again, I mentioned before, this Build Back Better Act has not been signed into law yet. So this is kind of my get out of jail free card for everything I'm going to talk about next, because anything in this bill could change. The Senate's going to be talking about it here, possibly making changes to it. So from here on out, just be aware that none of this has been signed into law. Now, a little bit of background on this Build Back Better. They first started talking about it in last spring of 2021. It started out at about $3.5 trillion. And now, like I said, the version that passed in the House is down to $2.2 trillion. And some of that's real reductions. And, some of it's actually, I don't know if you want to call them accounting gimmicks. But for example, there's the child tax credit in there, the increase for the child tax credit. In the first version, it was supposed to be for, I think, 5 years or so. And now it's reduced down to only 1 year. So that reduced the cost of the bill. But I think everybody's kind of thinking, well, we get a year out and they're going to want to renew it anyway. So it's hard to know really how much of that reduction from 3.5 to 2.2 is real reductions or just kind of timing reductions on shortening the span of these things. I have seen one thing that said that if all of the provisions in this $2.2 trillion bill would be extended over a 10-year period, it would actually cost over $4 trillion by the time we're all said and done. So it's kind of hard to judge. And again, we're talking a trillion here, a trillion there. Like they say, soon you're talking about real money. This act did pass the House on November 15th by a 220 to 213 vote. And at this point, there's no Republicans voted for it. And in the Senate, there's not going to be any Republicans that are going to vote for it. Republicans' take on this is we've already got inflation. We shouldn't be spending all this money. The federal government shouldn't be creating all these new programs. The Democrats, they think this is a great opportunity to expand the kind of the social safety net, I guess you'd call it. So really, what's been interesting on this whole thing to me is that historically what's happened in Congress is you've got the Republicans fighting against the Democrats. In this whole summer and fall, it's really just been the Democrats kind of fighting amongst themselves, which is, and not to be political, but it's just been kind of an interesting thing to watch, because I think early on, everybody thought, the Democrats control the House, they control the Senate barely, and they control the presidency. So I think a lot of people thought that this stuff was just going to fly through and be passed without question. And it's been interesting, the fact that it's been held up so long and that changes have been made to it that really, I would say, reduce the impact on a lot of the taxable type items in the bill. This bill, now it's in the Senate, and it has to be passed by a procedure called reconciliation, and that's why it's called the reconciliation bill. If you're not familiar with what reconciliation means, is the rules in the Senate say that typically a bill that passes the Senate has to be voted on by at least 60 out of the 100 senators. And currently there's 50 Democrats and 50 Republicans. So it's exactly a 50-50 split in the Senate. The tiebreaker is the vice president. So Kamala Harris, being a Democrat, she would be the tiebreaker. That's why they say that the Democrats still control the Senate. But there's an exception to that 60 vote rule. The exception is that if a bill only relates to revenue or budgetary type items, then the Senate can use a simple majority, the 50 or 51 votes to pass. So they're using this reconciliation procedure. Right now in the Senate, the one person that's really, I see a comment about political, I'm not trying to make political commentary, right or wrong. I'm just saying it's interesting. And right now in the Senate, Joe Manchin is more of a moderate Democrat, and he's got some things he doesn't like about this bill right now. Kirsten Sinema, I don't know, she's been another one that's raised objections. Those two senators, they're partly, responsible isn't the right word, but I'll use the word responsible for some of the changes from the September version of this Build Back Better Act to the version that's there now, trying to appease them a little bit. And the third person I listed here is kind of interesting, the Senate parliamentarian. And what is that? Who is that? Elizabeth McDonough. And that's not fair to say that she's holding this bill up necessarily, but when this reconciliation procedure is used, again, it has to be, the items only have to be related to the budget or revenue. And they're in this 2,100 page bill, there's arguments being made that some of this stuff in there isn't really related to revenue. There's some things about immigration reform, there's things about climate provisions, and probably a slew of other things too. So Elizabeth McDonough's position, or the Senate parliamentarian's role, is to kind of look at that and say, can these be voted on through reconciliation or not? So I'm trying to just give a little background of kind of how we got to this point. The bottom line is that it was passed by the House, and it's currently in the Senate. So Dan, you can go to the next slide here. And I think, I'm trying to think of the best way to explain this. And I think one way that I think is going to make sense is to start with what is not in this bill that's passed by the House. And the reason for that is because you may have heard on the news all summer long and all fall about all these potential changes coming up. And originally in the earlier versions of the bill, there were significant changes that would affect a lot of our Wegner clients here. For example, this list I'm going to go through here, the corporate income tax rate was supposed to increase in the earlier proposals. Currently, a C corporation tax rate is a flat 21%. The earlier proposals had graduated rates of 18% to 26.5%. There was a push to try to raise the corporate tax rates back up higher. That has been removed from the version that's been passed in the House. Similarly, the individual top rate increase, for a long time, they've been talking about wanting to raise this back to 39.6% from 37%. Years ago, it used to be 39.6, and then in 2018, it was reduced to 37. There have been talk all along about wanting to raise this back to 39.6, and that was what everybody thought was going to happen. In the version that passed on November 15th, that provision was removed. There's no more individual top rate increase. Same thing with the capital gains rate increase. The earlier proposals were saying that they wanted to raise the capital gains rate from 20% to 25%. That's been removed from the recent version. Dan, you want to go to the next slide? And then there's been also a lot of talk about this estate and lifetime gifting limits. So right now for 2021, an individual can gift up to $11.7 million per person. And there have been a lot of talk about reducing that down to $5 million. That, as of now, is not in the bill anymore. So that has been scrapped. Now, that limit, or the $11.7 million, that high limit, it is scheduled to expire at the end of 2025. And then at which point it would revert back to about half of where we're at. So it is scheduled to still, at this point, to revert back down to the lower amount at the end of 2025, unless it gets extended. But for right now, that 11.7 million, I think it's going to be a little over 12 million for 2022. And then there was also talk about getting, and I don't have this in the slides, there was also talk about getting rid of the concept of having a step up in basis. So if somebody holds an asset when they die, for a long time, there's been this concept of having the step up in basis. And there was talk about getting rid of that. That's not in this bill either. And then the last item here, the qualified business income deduction for pass-through entities. If you are a pass-through entity, you're probably familiar with what I'm talking about. There was talk about limiting that for higher income taxpayers. That provision has also been scrapped from the current version. So you're probably thinking, okay, well, they scrapped all this stuff about tax increases. And so how are they going to fund this? Or how is this bill funded? And I guess it's nice for our Wegner clients, because I don't think that it's really going to affect a lot of them in a big way. I'll just go through some of the things. So now what I'm talking about are the things that are in the bill. So I talked about things that fell off of the bill. These items that I'm going to talk about now are in the version that was passed by the House and being in the Senate right now. There's a corporate alternative minimum tax, but that's only for C corporations with over $1 billion in revenue. There's a 1% excise tax on corporate stock repurchases, but again, that's only for corporations whose stock is traded on established securities market, like the Dow Jones, and publicly traded companies. And then there's a whole list of other type things like international things, but they're all for really huge corporations. So that's one way they're going to fund it. Dan, you want to go to the next slide? There is an income tax surcharge of 5% on individual income over $10 million or $5 million if filing separately. And that begins in 2022. I can't say Wegner doesn't have any clients in that range, but I could say very few, if any. And then there's an additional 3% surcharge on income greater than 25 million, again, starting in 2022. So if somebody's over 25 million, they're really going to have the 5% and the 3%. So it'll be 8% higher. And you might think, well, why do they call this a surcharge? And why are they not just modifying the top tax rates instead? And I think the reason is because the thought is that a lot of the super wealthy people, a lot of their income is capital gain type income. So if they do a straight surcharge on income, they're not going to be limited by the capital gains rates. So I think that's why they went this route. And the Congressional Budget Office has been doing their scoring on stuff. I mean, obviously they think that this is going to create enough revenue, and so far it seems like they think it's going to create enough revenue to pay for this. So, or most of it anyway. And then this third one here, the third main bullet point here, expand the scope of taxpayers subject to the 3.8 net investment income tax starting in 2022. This is the one that could potentially affect a lot of our Wegner clients, S corporations in particular. So what the net investment income tax is an additional 3.8% tax on what they call investment income. It came about in 2012 with the Affordable Care Act, I believe. And historically, what it was it was supposed to, if somebody had passive investment income, they were supposed to get taxed on this. And the last many years, ever since it started, was if somebody was an owner of, say, an S corporation that they actively participated in, it was an active trade or business, that 3.8% did not apply to that. So what this Build Back Better Act says now is that for individual taxpayers who have income over these limits here, the 400,000 single or 500,000 married filing jointly, any income over that from your S corp or partnership, if it's not already being taxed at the self-employment tax, you'll get hit with this extra 3.8%. So this is the one thing that I think a lot of our, especially S corporations, are going to have to deal with. We have an S corporation that has, say, $800,000 of income flowing through to somebody's Form 1040. Effectively, it's going to raise their rate for that income over those thresholds to 40.8% in 2022 versus 37. And again, this is the bill as written. We don't know if this is going to survive or be changed, but this is probably the one thing I would say affects a lot of our things. There's a lot of our clients. There's one other thing, Dan, if you want to go to the next slide.
Yep.
Actually, go ahead one more slide if you don't mind. I think it's on the next one. One more. Sorry. And I'll talk about this now, the state and local tax, because this is another one I think that's going to affect a lot of our clients as well. In 2018, with what's called the Tax Cuts and Jobs Act, if you remember, they limited the itemized deduction for state and local tax to $10,000 on an individual return. And there's been a big push to increase that, because a lot of people in states, especially with higher property taxes and whatnot, a lot of even lower middle income people were being limited to $10,000 when even if they're not rich. So there's been a big push to increase that, and some of the people in Congress were trying to eliminate the cap altogether. That wasn't very politically popular because nobody wants to make it look like they're giving a tax cut to the super wealthy here. So the House's idea was to increase this from 10,000 to 80,000. And this little observation I put here is that in the Senate, I think they're even more interested in putting at least some kind of income limits on this. So if somebody makes $5 million a year, they're not going to be able to deduct a whole bunch of state and local tax. So I could see this as being one area that could change in the Senate. And I don't know if it's going to, change for the better or worse, but I suspect that there may be some income limits that it may stay at 80,000, but they may also add like an income limit. Like if you make over $500,000 or $1 million or something of income, maybe you can't do the full 80,000 or something like that would be my guess. So the SALT provision and the net investment income tax provision are probably the two biggest things from a tax standpoint that'll affect a lot of our clients. Okay, Dan, do you mind going back a couple of slides here? I'm sorry, I can't control this myself here.
Yeah, here we go.
Okay, so a few other things for individuals that's in the Build Back Better Act right now. They do want to limit retirement account balances. Again, they don't want super wealthy people to be putting tens of millions of dollars in these Roth IRAs and stuff. So, and I think a lot of people would think that makes sense. So what they're saying here is that if anybody who's got over $10 million in their IRA, that they would then be limited, or they wouldn't be able to contribute anymore. And then their required minimum distributions would need to be higher as well to try to bring that balance down, just to keep super wealthy people from deferring or hiding so much money in IRA accounts, when the purpose of IRAs is really just to provide retirement funds for people. The second item here, this backdoor Roth IRA contributions, that's when your income is too high to make a Roth IRA contribution. What people have been doing in certain cases, you got to be careful with this, but in certain cases, they've been putting money into a non-deductible IRA and then immediately converting it to a Roth. So they call it a backdoor Roth. That whole ability to do that would be eliminated effective January 1 of next year. And then similarly, Roth conversions would be prohibited for higher income taxpayers as well. So right now, anybody, no matter how rich you are, you can convert regular IRA money to Roth. And so they're going to put a provision in here to limit that for higher income people. The last item here, this cryptocurrency, if somebody's investing in Bitcoin or anything like that, they will now be subject to what they call the wash sale rules. And that's just that's an investment term for they don't want somebody to sell something on December 30th, take a taxable deduction for a loss, and then right away on January 3rd, within 30 days, buy it right back, because that's just kind of playing games with the tax law. So that's always been a rule for stocks and mutual funds and stuff. So now what they're doing here is they're just extending this to the cryptocurrency world. And then the child tax credit was increased for 2021. It used to be, I think, $2,000 per child. Now it's up to either $3,000 or $3,600 per child, depending on how old the child is. And this bill right now extends it just one more year through 2022, and along with those monthly payments. And one of the things that's I think interesting here, and the whole thing about this bill being in the Senate right now, is there's a lot of pressure being put on the Senate to try to pass this thing here by Chuck Schumer, the leader of the Senate, wants to try to do it by Christmas. A lot of the pressure on this is that these child tax credits right now are being paid monthly. So if you have kids, you may have been getting these monthly checks. Those are scheduled to expire. The last one would be December 15th here. So unless this monthly check concept is extended, starting next January, they're not going to get the kind of the monthly advance check anymore of this. So there's a lot of pressure to try to not let that lapse, because I think, again, politically that would look bad to let that lapse, no matter what side of the aisle you're on. So I think there is some pressure that is part of the reason there's some pressure to get this done if you follow stuff in Washington. And the two other things here, the earned income credits and the healthcare premium assistance credit. We don't have a lot of clients that use these things, but there are some changes, basically just extended some things that were in place for 2021. So I'm not going to get into the details of those two. Now there are some kind of interesting tax credits in there. A lot of this bill is geared towards climate provisions, and so they put in a lot of incentives here. The first one is the electric vehicles. Essentially, there had been credits for that. A lot of those credits have not been very usable because there were limitations on how many cars the manufacturers sold, and so on and so forth. So this bill now increases the potential credit up to $12,500 for electric vehicles, and even used vehicles now, pre-owned vehicles, could get up to a $4,000 credit. And there's all kinds of limits on taxpayer income. Again, they don't want rich people trying to get credits for this if they don't need it. And then there's also vehicle price limits. So if you have a $200,000 fancy electric car, well, they're not going to allow the credit for that either. So there are some limits on that. The second one here is kind of interesting too. There's a tax credit of up to $900 for the purchase of an e-bike. So here in Madison, I guess Crazy Lenny or whatever his name is that sells the e-bikes, I think he might like this provision. And then the last one, the credit for residential energy efficiency property. A lot of people have been putting solar panels on their homes, and the credit for that has been 30%, but then it's been scheduled to phase out here recently. This bill would extend this full 30% all the way through the end of 2031. So that could be very interesting for a lot of our clients that are looking to do something like that. And then we talked about the SALT limitations, so we can skip over that. And then just a few other things, and then I'm going to turn it over to Dan for the employee retention credit. So a lot of people ask us, what can we do for tax planning and things like that, or what are the limits for this year? So a lot of people take advantage of the Section 179 expensing limit for businesses. That limit is for 2021 is $1,050,000, not too much change from last year. And that is allowed for both federal and Wisconsin. And then there's also this concept of the bonus depreciation, this 100% bonus depreciation. And that works the same way, similarly to the Section 179, except there's no dollar limits on that. But the difference with bonus is that it's not allowed for Wisconsin. So for most of our clients, if we can utilize the top one, the Section 179 first, we'll do that. But that's still available. So if you're looking to defer business income by the end of the year here. If there's anything any new equipment you need to purchase or anything like that, that's still available for that. You can go to the next slide. And a lot of our clients ask, I've got a business, I've got a lot of business income this year. What can I do to reduce that? And one of the best ways is, I think, is just to make sure that you're funding a retirement plan. I think it's not only does it reduce your taxable income by funding retirement plan, but it's also a really good way to reward employees. And I know in this environment of employees being hard to come by and try to retain, I think that's an even better idea this year than ever. And then,
John, one item on that too. There are tax credits available for small employers that are starting up retirement plans, and that's not something that's new. That's something that's out there. So, if you are an employer that's looking at starting a 401k plan, there are tax credits available to help offset some of those costs.
Mm-hmm. Yep, absolutely. The second thing here, the Wisconsin entity level election, and the whole reason for this, and I'm not going to go into the whole background of this in the interest of time, but some of our clients have been doing this. And so if you're an S corporation or a partnership, there may be reasons to pay the Wisconsin tax at the S corp or partnership level instead of having the shareholder or partner pay it personally. And it gets back to that whole concept of the state and local tax, the SALT limitation, because when the SALT limitation was $10,000 on somebody's individual return, if they're paying $80,000 or $100,000 of business Wisconsin tax, there would be no deduction for that. Whereas if we pay it at the entity level, then it becomes deductible, a deductible tax. So, we've talked to our clients about that. The ones that benefit from that, I think we've talked about, and we've been doing for the last 2 years or so. If the SALT limit gets increased back to $80,000 or $100,000, that may reduce the reasons for doing that entity level tax, but we'll keep an eye on that. And then just some minor things here. Standard mileage rate for 2021 is 56 cents per mile. The IRA contribution limits there, no change to IRA limits for 2021 or 22, still $6,000. And then the 401k deferral limit for 2021 is 19,500. And then for 2022, it's going up 1,000, so 20,500. So just if anybody's interested in those limits. And anything else, Dan? Oh yeah, health savings accounts. We do have some clients that are in health savings accounts. Here's the limits for 2021, $3,600 for a self only, $7,200 for family. And then this annual gifting limit has been 15,000. It's going to rise to 16,000 for 2022. And so what that is, that means that, anybody can give, any other individual, up to $15,000 per year without having to file any gift tax returns or have any other type of tax, any other consequences or anything like that. So Dan, for example, Dan could gift me $15,000 here by the end of December. If you want to, Dan, that would be great. But it will go up to 16,000 for 2022. And then one little interesting minor thing for Wisconsin, state of Wisconsin, there's one of the middle tax brackets has actually been lowered from 6.27% to 5.3% beginning in 2021. So for what it's worth, everybody, at least in the middle incomes, will probably save a little bit of tax or a few bucks on Wisconsin return this year. You may not even notice it or see it, but it probably will be a little bit of a reduction. Dan, did you tell me something? You kind of figured out what the dollar amount might be for somebody in the middle income range? I forget what you said the other day.
Yeah, so that range for Wisconsin is taxable income. If you're someone that's making, let's say, $200,000 a year, this could save you easily $1,500 of income tax.
Or even that
someone
much,
making $300,000 a year, it could be $2,500 of income tax. So it's just about a 1% savings, and that bracket for married couples, starts off in maybe a $30,000 or $40,000 range, roughly to like $340,000 somewhere in there. So it is a tax savings for individuals in Wisconsin.
It's a big range, yeah. So actually, it probably adds up to more than what I was saying to begin with. Yeah, it was $1,000. That's quite a big saving. So.
Yeah, and John, you kind of stole my thunder. I always like to talk about gifting. And, my kids have got these 529 college savings plans set up. And if you want to gift to those, it's always encouraged to do that. And just a reminder on those gifting limitations, how does that work? It's an individual gifting limit. So I could give 15,000 to John, could give 15,000 to his wife, could give 15,000 to, both of his kids. And then I could do that December 31st, turn around January 1, and now give gifts of 16,000 to all of them. So we do have some clients for estate planning purposes that do issue these gifts to get that money essentially out of their estate. So that is a fairly common thing that a number of clients do.
Yeah, and it can add up because like Dan said, Dan could gift the 15,000 to somebody, and then Dan's wife could give 15,000 to the same person. And it's all about the person doing the gifting. So yes, I agree that it can add up pretty quickly. Is there any other slides here, Dan, for me? Or no? I guess in closing, I think, again, just to maybe summarize a little bit, I think it's actually been a pretty wild ride this year. It's been very interesting just watching the developments, because earlier in the year, again, there was all this proposals about raising the top individual rate, raising the capital gains rates, reducing the lifetime gift exemption, and then somewhere about October, it all just kind of changed, and they got rid of all that stuff, which is, I think, good for most of our clients. And then they came up with this concept of having new, or really going after the very, very, very wealthy people, people with over 10 million of income per year. So I'm not going to say whether it's good or bad how they're ending up. I think the process has been interesting. Maybe it's just because you're saying, oh, John, you're just an accounting and tax geek and you think this is interesting. But I think even besides that, that may be true, but I think even besides that, I do think it's been an interesting year. And I think it will be an interesting next few weeks if you watch the news, because again, there's a lot of pressure to pass this by Christmas. And I don't know if I want to make a prediction or not, will it get passed by Christmas or not? I'm almost leaning towards, I don't think they're going to make it by Christmas, because I think there's some things that still have to get done. Some of these things, like I said, with the parliamentarian, have to make sure that these are really related to revenue and budget. There may be some things the Republicans could throw in the works to try to stall this. My guess would be my guess is it's probably going to happen, and it's probably going to be pretty close to what we're talking about here now. It may not be signed until after Christmas, or maybe into the new year a little bit. But my guess is that something's probably going to get signed, and we'll have to see if what gets signed is very similar to what the bill is now. I don't think they would get straight too far from the framework they've got now, because otherwise they'd have to almost start over. So it'll be interesting. So that's my closing thoughts on the whole process. So we'll see what happens.
Yeah, John, the process to me seemed a little bit like, you're boiling spaghetti noodles and seeing if they're ready. And I've never actually done it, but I've heard if you throw them against the wall and they stick, then they're ready. It kind of seems like a lot of the negotiation has been throwing a whole handful of spaghetti noodles against the wall. And some have stuck, but most of them have kind of fallen off.
Yeah.
So it'll be interesting to see what happens in the next few weeks here.
Yeah. So stay tuned.
So.
Yes, one other thing. Yes, if something gets signed into law, we'll absolutely be putting out, blog posts or whatever to let everybody know what's going on. So.
Yep. So I'm going to spend a little bit of time here talking about the employee retention credit, and I'm going to plan to address questions at the end. So I will go over a little bit of the history here of the employee retention credit. This first became applicable in March of 2020 as part of the CARES Act. And that enacted the employee retention credit from March 13th to the end of December in 2020. Originally, I'll talk about it in the next bullet point here. In December of 2020, there was another act, the Consolidated Appropriations Act. And this expanded the employee retention credit to quarter 1 and quarter 2 of 2021, which was big. It changed some other receipts and rulings on it as well as the generosity of the credit. But the big piece of this one, in addition to expanding it, was also it made it eligible for PPP loan participants. The vast majority of our clients did receive PPP loans, so they did not qualify for the employee retention credit. But this new legislation in December of last year, so almost a year ago now, expanded it. So if you did take a PPP loan, you can also participate in the employee retention credit for 2020 as well as 2021. In March of this year, there was the American Rescue Plan Act, ARPA, And that expanded the employee retention credit to Q3 and Q4. And then in November, there was the Infrastructure Investment and Jobs Act, IIJA, and that retracted the employee retention credit in Q4 of 2021, except for recovery startup businesses. So what is a recovery startup business? I'm not going to get into a lot of detail on that. I'll give you one example. I've got a client that started up a small bar business in the area, and they started it in the fall of 2021 because they essentially started a business during the pandemic. They can qualify for this as a recovery startup business. So what is the employee retention credit? How do I qualify for it? So there's two ways to qualify. One is a gross receipts test, and another is if your operations were fully or partially suspended during any calendar quarter of 2020 or 2021 due to orders from a governmental authority limiting group meetings, commerce, or travel. And the big thing here is for the second one, there has to be a government mandate that limited operations of your business. So restaurants, for example, they were no in-person dining for a period of time, and then they had to be socially distant on their tables, so they couldn't fit the same capacity. They were impacted under a government mandate. Accounting firms, we went from working in our office to working remote. That doesn't qualify as a government mandate that impacted our operations for purposes of this credit. We don't qualify for this. So gross receipts test, I've got the next slide is going to articulate this a little bit better than I can just put in a whole bunch of text here. I think I violate just about all the rules by putting too much words on a slide here. But in 2020, you qualify in the first quarter that your gross receipts are less than 50% of what they were in the prior year. And you continue to qualify until you have over 80% of what you had in the prior year. In 2021, it's an 80% test or a 20% reduction. So you're looking at 2021 versus 2019. 2019 for the employee retention credit is the baseline for the gross receipts test for both years. And 2021 also, there's an alternative method that really helps a lot of businesses that we've seen qualify for additional quarters. And then I'm going to go right into this example on the next page. I think it's going to help articulate this a lot. So you might have to get your readers on if you can't see this. And we can also share this spreadsheet to others if they're interested in looking at it afterwards. Let us know and we can share that as well as the slides. So this is kind of an articulation here of example for the employee retention credit for the gross receipts test. And this particular business or organization, you can be a for-profit business, you can be a nonprofit organization, you can qualify in either one of those scenarios. You don't have to be either or to qualify. So we've got our quarterly gross receipts here, and I'm going to start in the second quarter of 2020. So I'm going to move my cursor over here, and we see in Q2 of 2020, the gross receipts were less than 50% of what they were in Q2 of 2019. Remember, 2020, if you're less than 50% of what you were in the prior year, you automatically qualify that quarter. In Q3, the gross receipts are actually higher than what they were in 2019. However, remember, you qualify in the first quarter, you're under 50%. You continue to qualify until you're over 80%. So this organization was over 80%. They were actually 125% in Q3 of 2020 when comparing Q3 to 2019. But that is, they still qualify for that quarter. It's just the last quarter they qualify for. In Q4, they're not under 50%, so they don't qualify. Now, as we look into 2021 here, the first quarter of 2021, the gross receipts are higher than what they were in 2019, but it's still listing this as an eligible quarter. So, what's going on here, Dan? You're probably asking yourself. And this is this alternative method for gross receipts that's applicable in 2021, where you can either look at the current quarter, in this case, Q1 of 2021 versus 19, and they don't qualify. Or you look at the prior quarter. And if you look at the fourth quarter of 2020 versus 19, there's more than a 20% decline. So you can use that for the following quarter and qualify. Again, Q2 of 2021, there's a drop here of over 20%. They qualify in that quarter. Q3, 2021 versus 2019, there's no drop. It's the exact same. But again, there's this alternative method, and the IRS issued guidance on this back in August that you can use whatever method you want in any quarter. So this organization, even though you look at them and they only had a decline of over 20% in one quarter in 2021, they were able to utilize the alternative method to qualify in quarter one by looking at the quarter four of 2020, qualify in quarter two by meeting the gross receipts test in that quarter, and then in the third quarter, use the alternative method to use the prior quarter to qualify. So this gets pretty tricky pretty quickly. But we found that a lot of clients have really been able to qualify for this. A lot of restaurants, a lot of retail, even quite a bit of construction type companies, where 2019 was a really strong year for a lot of companies. If you potentially downsized a little bit, if you're a nonprofit organization and maybe you had a big capital campaign that fell during 2019, so you would hire gross receipts in a particular quarter, there's a lot of ways that you can qualify for this. So, what's included in gross receipts? Gross receipts don't include PPP loans. So I don't have that listed on here, but PPP loans are not part of gross receipts. It's your total sales and all amounts you've received for services. It includes investment income, so interest, dividends, rents, so on and so forth. Gross receipts are not reduced by cost of goods sold, so it's not looking for like a profit margin. It's truly looking at the gross receipts. And then the last item here, this is one that's different for for-profit and nonprofit organizations. For for-profit organizations, you reduce gross receipts by the basis and the capital assets sold. So what does that mean? Let's say you've got a corporation that's got an investment account, and they've got a stock that they paid $5,000 for. They sold it for $20,000. They're going to take the $20,000 less the $5,000 of cost basis, and $15,000 is what they're going to include as their gross receipts. It's different for tax exempt or nonprofit organizations. In that same scenario, they've got a stock they paid $5,000 for, they sell it for $20,000. They report that total $20,000 as part of their gross receipts. They don't get a reduction for the basis and the stock in that situation. So that is one difference between for-profit and nonprofit. For-profit organizations get to count the basis that they have, nonprofit organizations do not. So the qualifying wages, it's wages paid to employees plus employer health insurance. And in 2020, there's the 2020 credit, there's some limitations. If you have over 100 full-time employees in 2019, it's only applicable for employees paid while not working. If you're under that 100 full-time employee limit, then all employees qualify. And just to specify this, 100 full-time employees, that is truly 100 full-time employees. There's no full-time equivalent calculations. If you have 200 part-time people and 80 full-time people, you're not above that 100 full-time limitation, and all of your employees on payroll qualify. There's no segregation of full-time versus part-time employees. All employees on payroll would qualify. In 2021, again, the same qualifying wages, employer health insurance costs, and that limit goes up to 500. So we have a number of employees that are over 100 full-time individuals that work for their business or nonprofit organization, but many of those don't have over 500 full-time employees. And again, if you're over that 500 full-time employee limit, only paid for people while they're not working. If you're under, it includes all employees. So the credit itself is very generous. It's up to $5,000 per employee in 2020. So the credit's 50% with the first 10,000 of wages in 2020. So it caps at $5,000 per employee. The 2021 credit is more generous. It's 70% of the first 10,000 of wages, or caps at $7,000 per employee. But the difference is 2020 is an annual $5,000 cap. 2021 is $7,000 per quarter. So if you've got 3 quarters that you qualify in 2021, the credit could be as high as $21,000 per employee. So I'm just going to touch over here briefly some frequently asked questions we've got. Where do I claim this credit? This credit is claimed on a payroll 941 form. So that's a quarterly payroll reconciliation form that gets filed with the IRS. If you have not done it, you can still go back and do those. You can file an amended return for those 941 forms, and you've got up to 3 years from the original filing to do it. So if you qualify in Q2 of 2020, you've got until July 2023 before you need to file an amendment. So it's not too late. How long till I get my refund? It varies. We've kind of had 3 different scenarios that we've seen. Scenario 1, the 941 form gets filed electronically. We've seen those refunds come back in, a month or so for many clients, where if you get those forms filed electronically, it's greatly going to expedite that refund process. We've had clients that file paper 941 forms. So they mail in their 941. In that case, it's been anywhere from 3 to 6 months, just depending on the client. And then we've had other clients that have filed these amended 941s to request the refunds. And it's been, anywhere from 6 to 10 months. If you filed something this spring, it's probably going to take longer to get your money than it would be if you filed today until you get a refund. Does the IRS pay interest? Yes, the IRS does pay interest on these refunds. We've had a number of cases where the interest on the refund is essentially covered our costs for helping clients with this. Do owners' wages count? No. It's no if you are over 50% owner or related to a group that's over 50% owners of the business. So for example, if I own a business 50-50 with my wife, we are related parties, we're over 50% combined, our wages don't count. If I owned a business 50%, John owns it 50%, we're not related, both of our wages would count, and any family members we have working for the business would count as well. So are there rules for ownership in multiple companies? Yes. These are called aggregation rules. And we've had a number of scenarios where clients have had multiple companies that have the same owner. All those companies have payroll, they're just different operations, or potentially there's a controlled group that owns a number of different corporations. There are rules in those scenarios where you do have to combine all of the employees for the number of employee test and all of the gross receipts for the gross receipts test. I will say there have been a number of favorable situations in those scenarios where if one of those entities had a partial suspension of operations under a mandate, so if one of those entities happened to be a restaurant, then it can kind of rope in and all of the entities can qualify even if some of the entities are not restaurants. So there's a lot more questions as you dig into that one. But if you own multiple companies with the same ownership group, you got to watch out for that one. Can Wegner help with this? Yes, we can. We've got a team that has helped compute the credit as well as file the amended 941 forms. We've done it for many clients, dozens, probably we're over 100 of completed tasks, I think, at this point, or tasks that are completed and in process. So we've had a lot of these projects, and we have also helped out smaller accounting firms that may not have the resources. We've helped serve their clients by offering this to those firms as well for their clients. Is there an alternative quarter selection? Yes, we talked about this briefly, where in 2021, you can look at a prior quarter to qualify for a current quarter. So is ERC still around for Q4 2021? No, except if you are a startup recovery business, it is. So, and the other one is this program for real? We have seen many clients with hundreds of thousands of dollars of credits. We've seen several clients with millions of dollars of credits, where credits are in the 7-figure range, and this program is for real. Many of these clients have gotten money back. Some of them are still waiting, but this is a program that's out there and it's extremely generous. So if you think you might qualify, certainly reach out to your professional that you work with, and we can kind of help with that analysis. So I just had one slide here on tax impacts for businesses that have received PPP loans. Those are tax exempt for federal taxes, and most states have also accepted that practice. It's a state-by-state basis, whether the states have applied the same rules as the Fed in that situation, but most states have also accepted that practice. And then we didn't talk about these, but SVOG, that's a shuttered venue operating grant. And RRF is a restaurant revitalization fund. Both of those are tax exempt for federal taxes. And then, if I get an employee retention credit, how does that impact my tax return? So the credit amount is is a loss of a federal wage deduction on income tax filings for businesses. Again, every state is a little bit different, but most states are still allowing the wage deduction. Wisconsin is allowing the wage deduction. Some states, such as North Carolina, are not. So in this situation, if your credit's $100,000, you lose that wage deduction on your federal taxes for the year of that credit. So if you're taking a 2020 credit, it's on your 2020 taxes. If you're taking a 2021 credit, it's on your 2021 taxes. It doesn't matter the year you receive that refund, it's the year of the credit. So I've got a couple of links here, and we'll share those as we share the slides on some other just COVID-19 resources on our website, as well as some resources from the SBA. The SBA administered the PPP loan program, as well as the EIDL, or the Economic Injury Disaster loans as well. So Q&A, I see we've got some here. I'm going to stop sharing for a minute so I can take a look at those Q&A items. There's one here about a step up in basis. So nothing in the works would eliminate right now a step up in basis for inheriting real estate. So that was a popular one in the spring that was maybe going to go away, but nothing right now is going to take away a step up in basis. So there's a question here about the quarters for gross receipts. So 2021 compares to the same quarter in 2019. The immediately preceding quarter, that alternative method, would look at the prior 21 quarter, the prior quarter in 2019. So for example, you compare quarter 2 of 2021 to quarter 2 of 2019. The alternative method, where you look at the prior quarter, compares quarter 1, 2021, quarter 2, 2019. There's another question here. Is there any way to qualify for 2021 ERC without having a decrease in revenue? You'd have to have a partial suspension of operations that's under a government mandate in order to qualify. So there are ways, but I think it's important to kind of always keep in mind the spirit of these programs is to help businesses that are struggling to retain people, or businesses that were under mandates that restricted their revenue. So we're not taking any real aggressive positions in this regard. But if let's say you're a restaurant and you couldn't operate at full capacity, but you had a lot of carryout orders and ended up having a little bit higher revenue, but you were still subject to governmental mandates, then you can still qualify under that partial suspension of operations. So there's a question here about, instead of waiting for a refund, can we apply the credit towards future payroll taxes? You could if you did it on an original return, but on the amended returns, you receive a refund for the overpayment. So you can't apply it forward on amended returns. So you could have on original filings, but at this point, there's only amendments, so that's not going to be applicable. There's a question here. How can you find out if Illinois is still accepting the wage deduction or not? I haven't seen this info. So I don't want to get too technical, but this credit is a federal wage credit. So how we have started off looking as, if you are in a state where that state allows a deduction based upon a federal wage credit, that's kind of the starting point. I can tell you Illinois does allow a deduction for federal wage credits. Whether they also are going to allow the deduction for the employee retention credit, generally you have to look that up separately. So if they haven't passed anything in regards to whether the wages are going to be non-deductible, then I would probably start with, if they deduct federal wage credits as an allowable deduction before calculating their taxable income, that you kind of start with that. There's another question here. If you received your 2020 ERC retroactively, do you need to file an amended return for 2020? So the answer to this, if you're filing for a 2020 ERC, today you're submitting that filing, it wasn't available when you were filing your 2020 tax return, you would need to amend your federal return, report that non-deductible amount on your 2020 taxes.
Yeah, and that was a question in the chat as well. So that was good you addressed that. There's one more, I think, question in the chat. Can you please tell us a little bit more about how the PPP and ERC are connected? You just talk about how you can't use the same wages for the same, for both of those together. I think that's what the question is about.
Yeah, yep, happy to do that. So essentially, what's the strategy if you have a second, first PPP loans are kind of done right now. So second PPP loans, if you haven't submitted that forgiveness application and you've got quarters where you qualify for employee retention credit, there's a little bit of a strategy there. You can't use the same dollar twice. So you can't use the same dollar for PPP forgiveness and for the employee retention credit. So essentially what you want to do is use as many non-payroll costs as you can for your PPP loan. So facility costs is just rent, utilities, interest you're paying on a mortgage. And then you want to use payroll costs that are not eligible for the employee retention credit. And what might that be? That's owner's wages, if you're greater than a 50% owner, or family members of that greater than 50% owner. You want to use retirement plan contributions. So I've got a number of clients where they have 401k plans that they contribute to. And when they make their profit sharing, if they did that during the covered period, they can use that as a qualifying payroll cost. And then on a much lesser level, disability and other employee life insurance premiums that a company pays for employees, as well as state and local taxes, so state unemployment. So those are typically smaller numbers, but we run a lot of that analysis for our clients, where another piece of this puzzle is the employee retention credit caps out at 10,000 of qualifying wages on a quarterly basis. So for individuals that are compensated above that on a quarterly basis, there's that gap above that can be fully utilized for PPP. So feel free to reach out after if you have any additional questions on that, but there is some strategy in that regards. And simply put, in a lot of cases, if you already submit your PPP forgiveness and you qualify for the employee retention credit, you just can't use the same wages twice. So I think we already addressed this. If you have filed your 2020 tax return, but you do qualify for the employee retention credit, you would have to amend your 2020 taxes, report a non-deductible amount equal to the credit. I think that answers all the questions. If there's any additional ones, feel free to reach out. And I will share my screen quick so you have our contact information.
Yeah, thanks for joining us, everybody. And again, watch the news the next few weeks. It'll be interesting to see if this gets passed by Christmas or not, this Build Back Better Act. So
thank you so much, John and Dan, for all of your expertise this morning. We certainly appreciate it. As you can see, John and Dan's contact information is right there. If you have anything that comes up after the webinar that you want to reach out and ask them about, and keep a lookout in your email for the slide deck and the recording that will be coming from me. Thanks so much, everybody. Have a great day.